but the elderly also have publicly funded Medicare. Yet we see a sharp division between the majority and a struggling minority of the retirement sector. Roughly 15% of US seniors are considered in poverty today. In contrast, on the other end of the spectrum, many well-off seniors have tremendous wealth and a disproportionate impact on the markets and the overall economy. As of last year, people over 70 controlled 39% of all equities in the entire marketplace and mutual funds that were owned by households. This is compared to 22% in 2007. Their share of net worth was 32%, which is up from 20% 2 decades before. The average net worth of people aged 65 to 74 is 1.78 million today, while the median is far lower, around 400,000. Well, let's jump into it here. Let's jump into our retirement masterclass. We got a few things tonight. We got State of the Union coming up, etc. So we're going to respect everyone's time and kick this thing off. So today, what we are going to cover in the retirement masterclass. First things first, retirement scenarios and life expectancy. There's been a lot of changes in how retirement planning has adjusted with a lot of new variables. We'll talk about stocks. We'll talk about bonds. We'll talk about portfolio diversification and how these were historically and what diversification really looks like today. We will talk about withdrawal strategies. Some good strategies that are continually updating and what that looks like using today's marketplace. And then this one's interesting, the spending paradox. This one's big. I'm going to give no hints on that because you guys got to wait for that slide because it's that good. But first, I know a lot of names on here. I've seen y'all on a lot of webinars, but if you haven't, and if I haven't gotten a chance to meet you or introduce myself, my name is Nic DeAngelo. I am president at Saint Investment Group. I'm blessed and honored to be a thought leader in this space. I get to appear on podcasts, stages, webinars like these are my favorite. We host these live webinars monthly, actually twice a month, one for our investment community and then one for these deep dive topics like this. But what I'm most proud of is that Saint has over 600 mortgages in over 29 states and growing. We have over 200 million in assets under management. We pay fixed returns. We have a fixed income fund that pays up to 14% returns, and we've never missed a distribution to our investors ever. That's been for over a decade. That's what I'm most proud of. So we like to say always on time, every time. And that's a little bit about me, just to kick things off. This is one of my favorite slides. This represents a ton of hard work from the Saint team. We have over 14 million distributed to investors, a wide, diversified portfolio on our side we're really proud of, and our team works their butts off, so they deserve all of the honor for all this hard work here of the things that go into the day-to-day business at Saint. And we get asked all the time what investors have to say, so we just included a slide. These are some investors, some people we've worked with in the past that have invested, but don't take our word for it. I think Saint is amazing. I think we're a 100 out of 10 organization. The best place to look for third-party reviews, I'll give you two. The first is going to be Trustpilot. You can see dozens and dozens and dozens on there, as well as Google, simply put. So if you guys want to hear what other investors, what their experiences are with us, I encourage you guys to check out Trustpilot and Google. And as always, I mean, I see a lot of our investors in here tonight. If you've had a good experience with us, drop it in Trustpilot or Google as well. We always like to hear from you guys. So we have a lot to cover today, and we're going to make sure we jump into the topic. But before we get too far, I wanted to take a minute here and introduce you guys to a very important member of the Saint team if you haven't gotten a chance to meet yet, Mr. Tom Furlong, who is our Director of Investor Success. So Tom, can you jump in and give a little intro about yourself and tell people where they can learn more about Saint and get connected with you?
Absolutely. Yeah, thanks, Nick. So as Nick mentioned, my name's Tom Furlong. I'm the Director of Investor Success here. We're so excited to be working with each and every one of you. I work with just about every investor in our income fund. We'll be giving some great information, and Nick's going to get a deep dive in the Retirement Masterclass. But I'll be working behind the scenes. So if you have any specific questions about your situation, or if you're looking to learn more about investing with Saint and our income fund, I'm more than happy to set up a time to talk with you, and I'll just drop my information just directly in the chat. I've raised over $200 million from investors, institutions, retail investors, business owners, doctors, lawyers, you name it. Really, I'm here as a resource for you guys along your investment journey. And at the same time, if you decide at any time during this webinar that you'd like to make an investment with us, we're honored to start the partnership with you. If you're a current investor, we're honored to continue the partnership with you. So I'll be available during this call at the same number. And again, I'll just drop that here in the chat here. Uh, Sent that one in 949-658-3378.
Perfect. Tom, thank you. Guys, I want to just reiterate, Tom's humble, but he is an amazing resource. I highly recommend that you guys get with him, talk about what you're working on and what goals you're trying to achieve. Tom can give you a ton of information. He's worked with hundreds of millions of dollars, hundreds of investors, and can give you guys insights on what he's seen throughout different processes. So you have his information in the chat. If at any time during what we're going through tonight, you want to learn about what Saint does, how we do it, and what Tom whatever insights Tom can provide on your specific situation, get with him and compare some notes, guys. All right, let's kick things off. Let's get into it. So thanks, Tom. Here's a breakdown today, guys, of how this presentation will go. We'll start off with a legal disclaimer. Then we are going to jump into our retirement masterclass topic. After that, we'll go into some brief housekeeping, and then we'll wrap up with some live Q&A, continually, consistently ranked as one of the best things that every month as part of these live webinars. It's the live Q&A. It's interacting between the audience, interacting between our investment community. So I'm excited for that as well at the end. And I encourage you guys to read this slide. It's our slide to keep our attorneys happy here. But here's the overall, here's the overview, here's the kind of main points. One, this is not investment advice. Two, this is for educational purposes only. All investments carry risk. Past performance does not ensure future results. And then a couple that I personally add in here. One is that I'm going to be talking about a ton of numbers throughout today, especially off the cuff in the Q&A section. We get into some economic details and compare notes. I encourage you guys to double check my numbers, especially if they're off the cuff in those situations. And then last note, we work really hard on these. We want to give you guys amazing information. So just a reminder that Saint owns all the rights to this material throughout the presentation today. And our bonus. So guys, we do a monthly book club at Saint. This is a free book that we give away. It's something that we're reading internally as a team. It's something where we are covering something that integrates well with the topic and helps us understand the market around us, et cetera. In the top books we recommend back to you guys. This one is How to Retire. Couldn't be more on the nose for this month's topic. The reason we chose this book is because this is a great option that goes through all the different steps and situations within retirement. Withdrawal strategies, tax planning, annuities, purpose, lifestyle, etc. And it updates the classic ideas that have been around for decades with what's going on in the market today, much like we'll do in the presentation. But this is an extra deep dive. So if you want this book for free, I'm going to tell you how you can get it. Comments in the chat, questions in the chat, responding to polls, the live Q&A at the end. Ask questions. Let's have an amazing conversation. And then last, leaving a review for us on Trustpilot or Google. So it's about engagement. We just want to hear from you guys. We want to have the fun conversations. If so, if you're a great engager today, we want to send you this book for free. And if you're not able to join us for the whole webinar, we actually included a QR code. We don't make any money off it. It'll just get you to the Amazon so that you can buy the book yourself. Without further ado, let's jump in, right? Okay, so retirement scenarios for different segments of the population. The elderly population in the US today is in a generationally unique situation. They are out of or soon to be out of the job market, and they don't need to worry about being replaced by something like artificial intelligence, a major shakeup in the labor markets today. The majority of new retirees own their homes, and oftentimes that is debt-free for those homes. Everyone worries about healthcare costs, for sure, retirees especially, but the elderly also have publicly funded Medicare. Yet we see a sharp division between the majority and a struggling minority of the retirement sector. Roughly 15% of US seniors are considered in poverty today. In contrast, on the other end of the spectrum, many well off seniors have tremendous wealth and a disproportionate impact on the markets and the overall economy. As of last year, people over 70, as of last year, people over 70 controlled 39% of all equities in the entire marketplace and mutual funds that were owned by households. This is compared to 22% in 2007. Their share of net worth was 32%, which is up from 20% 2 decades before. The average net worth of people aged 65 to 74 is 1.78 million today, while the median is far lower, around 400,000. That disparity is showing us that a small group of ultra high net worth individuals are pulling up the overall net worth averages of that age group. So, even those without savings and investments are not without assets if you consider the situation. Translating Social Security into present value terms, the average retiree at age 65 in 2019 had an inflation indexed annuity worth equivalent to about $305,000. But stated in today's dollars, that's roughly a $390,000 value from the government with the Social Security benefits there. Increasing life expectancy. This is an important one. What we've seen is the foundational assumptions, the basic things we assume about retirement, they're changing. And the strategy for retirement in the modern era is changing with them. It must change with them. In 1975, US life expectancy at birth was approximately 73 years old overall, between men and women averaged. By 2023, US life expectancy had increased to around 79 years, so roughly 6 to 7 years higher than in the mid 1970s. Over the period from 1950 to 2024, US life expectancy rose approximately from approximately 68 years to just over 79 years, but progress had been uneven due to factors like the opioid crisis, COVID-19, and some other health things along the way. The 11-year increase in average life expectancy has led many to worry about whether they will outlive their retirement resources. Simply put, surveys of individuals capture a softer view. The average self-reported actual retirement age is around 62 today versus about 57 in the early 1990s. So Americans are working longer on average for their lifetimes, even though many still end up retiring earlier than their personal plan due to health or job shocks along the way. And worth noting here, international patterns are similar to the United States on these topics. Across the developed world, the effective retirement age has risen in almost all member countries since the late 1990s. Studies note that an average increase of about 2.3 years for men and 2.7 years for women over the last 2 decades as well. Projections in 2025, the updated projections in 2025 show future normal retirement ages reaching 70 or more in well-known first world countries, Denmark, Italy, Netherlands, Sweden, etc., if life expectancy continues to grow as expected. Overall, both the US and across the world, we are seeing retirement ages continually going up over time, as well as an increasing life expectancy. And this makes retirement planning and investment planning more important than ever. So, how are we preparing for these longer retirements? I love this chart on the left. It's this chart on the screen here. It tells us a lot, and we'll dive into that now. For decades, investors have followed guidance designed to optimize asset growth while protecting against losses. This is the goal, right? This was the classic 60-40 portfolio, meaning 60% in stocks and 40% in bonds. And the advice worked, well, for a while at least. Because historically, over roughly the last 50 to 100 years, a traditional 60-40 portfolio has returned on the order of 8 to 9% a year before inflation, or about 5% a year in real terms after inflation. So not stellar in real net terms, but a lot more stable than many other options in the marketplace. But in 2022, as we see on the chart, the bottom fell out of the 60/40 portfolio. We saw a major shift in the markets. The 2022 drop is the reason for the crisis of confidence in the 60/40 portfolio. The 2020 catastrophe for the 60/40 portfolio was due to the failure of the defining feature of the 60/40 strategy. The strategy uses bonds to cushion the fall of stocks, while stocks have the higher upside potential than bonds. So they theoretically benefit and balance out each other, right? Conceptually, this sounds great, right? Until it doesn't work. So in 2022, both stocks and bonds fell sharply in response to an inflation shock and aggressive Fed tightening. If you're looking at different indices, this is roughly a 20% reduction, depending on which index you looked at. Morgan Stanley called it the worst decline for a 60/40 portfolio since 1937. In fact, the decline of the 60/40 portfolio in 2020 and 2022 alone was more severe than an all stock portfolio. So at that moment, you're better off just owning stocks than having that 60/40 balanced portfolio. Very interesting, a very interesting case study that one year. So is the 60/40 portfolio dead? That's the real question at the end of this discussion. This record-breaking disaster for the 60/40 portfolio in 2022 led many to declare the demise of the whole 60/40 model. But the reality is the decline was pretty short-lived. This model has bounced back, as we can see. Following the trough of 2022, returns have been more balanced, as we see on the slide. What we've seen is that we've returned to roughly around 11% annualized since 2019, which also includes the 2022 drop. So what is the optimal approach to retirement preparation, considering the need for resources to support retirees longer, which we went through in the previous slides? The CFA Institute notes that the 60/40 remains popular with investors because it still has the resilience, simplicity, and diversification, but advisors like State Street and Schwab refer to this model as a core approach for retirement still. This structure is most common for retirees whose essential spending is covered by guaranteed income. That is the asterisk here. So the 60/40 portfolio is not dead. It's actually far from it. But it seems that today it's being used most effectively by retirees that just need something that has lower returning and consistent returns over a long period of time. So they don't need the higher returns. They need higher consistency with lower net returns. Still, the 2022 experience had resulted in more attention to the drawbacks of traditional investing theory. And it has also increased interest in alternatives like real estate, private credit, etc. Many famous and high-performing advisors in the market today, most notably BlackRock, the largest investment group in the world, they have responded by adding greater diversification to both the equity and fixed income elements of their funds. We are now seeing the 60/40 portfolio start evolving and could be more accurately described as maybe a 60/20/20 portfolio, where we target 60% equities, or BlackRock rather is targeting 60% equities, and then 20% for stocks, and then 20% for varied alternatives. Again, real estate, private credit, etc. We are seeing many institutional investor portfolios shifting even more than this, with up to 50 to 60% allocations to alternatives like real estate, as many other industries struggle, where their venture capital and tech investments in the past filled a huge gap in their portfolio, filled a huge slice of their pie. They're getting away from the tech side. They're getting away from the venture capital, and they're backfilling that with alternatives like real estate investing. So adoption levels. There's a lot of data on this slide, but it's so good. This slide is about adding alternative investments to a retirement portfolio. Alternatives like real estate have moved from niche to Main Street in advisor practices as well. And this is especially true for high net worth and ultra high net worth clients who typically have more sophisticated portfolios. For example, Goldman Sachs now notes that increasing your allocation by 12% to private assets, right? Alternatives, private credit, real estate, private equity. These can increase your returns by 40 basis points a year. So for 12% of your portfolio shifting over to private assets and alternatives, you can get almost 0.5% increase on your returns annually. Goldman Sachs, very interesting. We're also seeing higher adoption levels. So that rate is increasing. A 2025 survey of 500 plus US advisors finds that 92% of US advisors are now incorporating alternative investments into client portfolios, a huge jump up. We're also seeing that 91% plan to increase allocations over the next 2 years. In that same survey, private debt, private equity, and real estate are the top alternative investment classes advisors are focusing on over the next 2 years. A 2025 Financial Planning Association survey reports double-digit year-over-year growth in advisors using alternatives, including private debt, real estate, and other assets. So we see trends in which alternatives they are targeting. This was driven by investors wanting diversification. The investors have been pushing for it and having built up demand on that side, and also being concerned about stability of returns from stocks and bonds. Guys, if you haven't seen our webinar, this is a quick plug because this is really important, and we've beaten this to death on the stock market. If you haven't seen the great melt-up webinar we've done on the stock market, it's extremely enlightening. It chops through all the different data of the stock market, all the things to keep an eye on that you're not seeing in the normal financial news day in and day out. That was a little aside here. But for high net worth investors, top performing advisors are increasingly viewing private real estate and private credit as the standard components of a diversified portfolio and no longer as exotic side bets or just rolling the dice. They are now considered a core component from high sophisticated advisors. Okay, we have a poll and we love to hear from you guys because at the end, we're going to read the poll results. These polls have a ton of value, so I'll read these out loud and give you guys a little idea.
Wow, this
How
is cheating.
satisfied? Go ahead.
I was
Mitch.
gonna say the
Hop in.
results were coming in and it was like massively swayed for a second there.
I'll grab a sip of water.
Okay, I'm gonna end it here in 3, 2, 1, and then we will look at the results. Get them in, get them in. All right, there we go.
Okay, so the poll results. How satisfied? Hold on, can you guys see that now? Popping
No,
up on the screen?
There we go. I popped it up.
Okay, can you see this on the screen? Is that in front of the slide or no?
It should be in front of the slide. Drop in the chat if you can see this. Yep,
Okay.
there it is. Thanks, Brad.
Okay, perfect. How satisfied are you with the modern retirement advice coming from big institutions? Wells Fargo, Morgan Stanley, etc. We have from very satisfied all the way down to I've stopped listening. I'm looking for alternative strategies. So we got the whole gamut here. And I've got to say, relatively balanced in the results. The winner, though, we have a ton of people on this one, so this is very interesting. The most votes we got are underwhelmed. It feels like the same playbook from 10 years ago. I could not agree anymore. The whole retirement look needs to be updated. It needs to be reanalyzed. And so that's what we're doing here is trying to get the most up-to-date data and provide that for you guys. So I do feel underwhelmed when looking at retirement data and strategy. It does feel like it's a decade old. So thank you guys for sharing. That's really helpful. I'll pull this up here. There we go. Okay. Let's keep moving. Private credit. Let's talk about private credit a minute. A big growth opportunity here. So let's talk about private credit. BlackRock and others highlight that diversified private credit strategies have recently delivered mid to high single-digit nominal returns. So we're talking, 7 to 8% here. These often have floating rate coupons that adjust as short-term rates move. So as there's market volatility, there's a lot of benefits to a private credit investment strategy. We have inflation and rate sensitivity. Because many loans are floating rate, income can rise when central banks hike to fight inflation, which makes private credit a partial hedge against the rate and inflation risks that hurt traditional bonds in 2022. Bruce, you hit the nail on the head. Unless you're Blue Owl, which again they bet heavily on the tech sector. That is funny. That's dead on, Bruce. So Blue Owl guys, I encourage you to check that out offline after this. But they did a little too much private credit investing with a little too much focus on tech. That's all. That's a quick, overly simplified note. Also, private credit diversification. Private debt has shown attractive performance and low correlation to public bond markets, and it is likely to become a central component of bond allocations over the long term if risks are properly managed along the way. Private debt typically offers higher yields than public credit. This is partly as a result of the premium paid to investors for committing to less liquid loans, as well as the complexity of these offerings. And the complexity is a drawback, to be fair. Some of these have very, very complex structures that are beyond what any investor should really be getting into the weeds to that degree on a credit investment. Brad, interesting take on the stock market. I want to hear more on that. So, are we going to see private credit in mass market retirement accounts? Right? We're talking about retirement. Excuse me. We are talking about retirement today. So, will we see private credit in mass market retirement accounts? The answer is yes. Major managers are already doing this. State Street, Empower, Goldman Sachs, Blackstone, and many others. They're already launching funds with these strategies included for retirement. These investments, private equity, private credit, real estate, are now being created intended to be used for 401k plans. That's a major shift. So how far will the expansion of alternative assets into retirement planning go? That's the real question. And also, what drives the retirees' fears along the way? We see that inflation is consistently, as you dig into the fears of retirees, one of the biggest concerns over the long term. So the EBRI, the Employment Benefit Research Institute, did a retirement confidence survey. What they found is that 70% of retirees are concerned about inflation. So over 2/3 have a major concern about inflation, while 40% of those concerned about the retirement resources cite inflation as the single most reason. The Schroders 2025 retirement survey reports that 92% of retirees are at least somewhat concerned about inflation eroding their assets, while 84% say they wish they could protect their savings better from inflation. Like they're not doing enough and they wish they had better strategies for it. Let's talk inflation and the erosion of purchasing power, which is the real core of the inflation concern. Survey data show that many workers and retirees who lack confidence in their retirement readiness also cite that inflation and lack of savings as their primary reasons. Nearly half say that healthcare costs, that's a theme that's going to keep coming up, healthcare costs. Nearly half say that healthcare costs have been higher than anticipated, while current workers say that high healthcare costs have constrained their ability to save for retirement, period. A Society of Actuaries paper models that if inflation averages 2.5%, right around there today, right? If inflation averages 2.5%, someone who needs $50,000 at retirement today will need about $80,000 after 20 years just to buy the same basket of goods. So over time, that extra piece of inflation impacting the value of investments is major. It makes a huge impact. If inflation runs higher, the required income rises faster as well, forcing either bigger withdrawals from the portfolio or lowering real spending and lowering quality of life, both of which affect sustainability of a retirement portfolio quite a bit. Inflation really does matter for whether assets last, but how much it matters depends on the level and timing of inflation and how flexible the retiree is with their own spending. For example, Morningstar's withdrawal research report finds that retirees who face high inflation early in their retirement are more likely to run out of money unless they significantly cut spending, even if the market returns are reasonable. So the timing that they run into inflation problems, which is entirely outside of their control, that matters very much for the future of their retirement, their entire retirement future. The Center for Retirement Research finds that without any behavioral change, high inflation clearly harms older households disproportionately, cutting both real consumption and wealth for the older retirees. In practice, many near retirees and retirees respond by cutting savings and increasing withdrawals to keep their standard of living. So if they have to choose, which is a very American trait right now in modern society, if you have to choose between cutting spending and spending more and drawing down and selling investments, more Americans are choosing to sell more investments and maintain their same lifestyle. So, with all that said, where are investors getting their advice in the modern retirement sphere? Interestingly, only one third of those are completely satisfied with their financial advisor's advice. I mean, the obvious quote or the obvious data here is that 2/3 of investors are not satisfied with their financial advisor's advice. That's brutal. Studies also show that investors consistently doubt their advisor's success in tax efficiency, inflation management, and estate planning, which are three of the biggest pieces of retirement, three of the biggest considerations. What we typically see is income generating assets are key components of a robust retirement portfolio, and they resolve major issues with concerns about the advisors. Income generating assets, things like commercial real estate, private lending, successful businesses, etc. These are key components of a robust retirement portfolio. Large managers like BlackRock, Goldman Sachs, they are pushing to integrate private equity, private credit, etc. into retirement projects such as target date funds and DC plans. Here are some other places investors are getting their financial advice. 71% of high net worth investors are using a financial advisor. No real shocker there. 2/3 of high net worth individuals have an advisor. But here are some more shocking ones. 91% of investors want advisors who embrace forward-thinking technology. 33% of high net worth investors want advanced technology behind their retirement account, such as AI projecting. 97% of high net worth investors are now using AI-driven tools in their own investing strategies. This is up from 74% just a year ago. So now you have a balanced and stable portfolio. Let's check in. I'm reading. I love the back and forth in the chat, guys. You guys have amazing questions. We'll circle up on a lot in the Q&A also. Okay, so you have some sustainable withdrawal strategies. Now you have a balanced and stable portfolio. What are strategies that are used to withdraw appropriately over the retirement years? The original and still used benchmark is the 4% rule. The 4% rule is based on US data from 1929 to 1991 and was intended to support a 30-year retirement by withdrawing 4% in year one and doing that annually while adjusting annually for inflation. The 4% rule is a simple guideline for turning a retirement portfolio into income, and it's a more simplified more simplified calculation year after year. It says withdraw 4% of your total invested savings in the first year of retirement. So, for example, if you have $1 million portfolio, you can withdraw the $40,000, the 4% of that million per year, but you have to adjust annually for inflation and take that into consideration. This rule, again, was designed for roughly a 30-year retirement with a balanced stock and bond portfolio, aiming to give you a high likelihood that your money will last for those 30 years while keeping your inflation-adjusted spending roughly stable over time. That is the goal. The original study is called the Trinity Study. It used US data from 1926 to 1995, and it found that a 4% initial withdrawal with inflation adjustments every year from a 50-50 stock bond portfolio had a 95% success rate over a 30-year retirement, meaning that the portfolio did not deplete in 95% of rolling periods for 30 years. So the 4% rule is a good starting point. The data does support that. Okay. But it's not a guarantee. 1 out of 20 didn't make it. It is affected by current realities such as longer lifespan. The 4% rule is for a 30-year retirement. Okay. The historical retirement average was 20 to 25 years. People are living longer. People are now living into those 30-year retirement ages. We also have lower bond yields than historical averages. So this leaves investors often looking for higher fixed return investments as bonds are remaining lower on their return scale. We also have healthcare inflation. Again, I said this would come up over and over. Healthcare inflation is outpacing general inflation. So if general inflation is at mid to high twos, healthcare inflation is consistently outpacing that, meaning retirees incur these costs and they are very close to home for the retiree community. Another reason retirees are commonly looking for higher stable returns to offset the lower bond yields. And then we often see modern dynamic approaches in the market, such as adjusting spending based on portfolio performance, inflation, remaining horizon, etc. So basically retuning that 4%. And then what we see consistently as well is that high net worth individuals have an obvious advantage. They can afford more flexibility. They utilize better tools like investing in alternatives more broadly. They also utilize strategic tax planning. These things give them a leg up over a longer term 20 to 30-year retirement horizon. And as I promised, the spending paradox. Let's talk about it. You guys can read the slide, but I'm going to dig into it a little bit. There is this thing called the spending paradox, and it's a new idea in the retirement world that's popped up in the last decade or so. Commonly, retirees have two options in the retirement phase. Number one, they can spend conservatively in a way that passes down a large amount of wealth to their next generation and also gives the retiree a safety net in emergency situations. That's kind of the common approach. That's standard middle of the fairway. Option two is do the opposite. Spend quite a bit more, live a higher quality of life in retirement. Enjoy those years from the years of hard work that you put in, right? Spend on bigger experiences, leave less for the retirees' heirs, and have a lot less safety as well, have less of a safety net for themselves in emergency situations. That is a trade-off of stability over the longer term. What we see is something that's emerging is somewhere in the middle. It's that shades of gray, something in the middle. Retirees spending more money than the classic approach, but spending it on things like travel with their children and grandchildren, creating experiences for today with their loved ones, right? Things that the people that they want to share that with. So they are raising their quality of life, but they're choosing to do that with the people most important to them, and invest in things like education for their grandchildren, et cetera, things that they can get return on today while they're alive and enjoy that. What we're seeing is that many high net worth retirees spend less than they could. So this is where the paradox starts. Many high net worth retirees spend less than they could. Most maintain or grow their assets rather than draw down to the fullest extent. They're not even close to that 4% if you're using that as a benchmark. Many say tongue in cheek, they intend to bounce the last check at the end of retirement. When in actuality, if you look at the high net worth spending habits in retirement, most spend in a way that preserves capital. Surveys routinely show that retirees say that their top goal is to maintain or improve quality of life in retirement rather than maximize their bequests, yet their slow drawdown patterns look more like wealth preservation consistently. In a 2024 survey, we find that retirees with annuitized income spend roughly twice as much as retirees with an equal amount, but it's non-annuitized income. Interesting. That's an interesting point. So they return the same amount. They have the same amount of income, both retiree groups, but those that are coming from annuities spend twice as much. This is because retirees, according to the study, this is because retirees feel more comfortable consuming from a contractual income than from a fluctuating account balance. That makes sense. It's not exactly not smart, right? That's about as strategic as you can get in a retirement phase. Retirees are consistently feeling uneasy about their portfolios when they're based on floating returns like equity investments, like stocks, and typically will be much more conservative than if they had fixed income or guaranteed returns as the core of their investment strategies. So that was the investment. That was the spending paradox. That's a fun one, very interesting. There's a lot of data to go into there a different time. But here are the key themes. These are the major themes, the major takeaways of our findings when we did our retirement deep dive on the analysis side. Number one, core plus portfolio construction. This is a consistent winner. For high net worth retirees, the center of gravity is still a diversified stock bond core, but not a bare 60-40 portfolio strategy. The idea is a core plus design. So using a balanced public stock market core, stocks and bonds, right? Sized to your risk tolerance, your liquidity needs, your tax, et cetera, your tax considerations, et cetera. And around that core, it's adding in alternatives. It's adding in private credit, private equity, real estate, et cetera, private debt along the way. Also, this improves income, this improves diversification, and it improves long-term real return potential. We also see that the guiding objective here of real returns is achievable, even from Goldman Sachs studies. They're seeing the same trends. Next is risk management beyond just volatility. Sequence risk matters. What that means is sequence risk. Bad returns early in retirement can permanently damage a portfolio due to a lower base of compounding growth for the remaining term of that portfolio. There's also healthcare shock that can be caused by out of control healthcare inflation or catastrophic uncovered expense. There's also policy risk, changes to tax law, Social Security, Medicare, et cetera. Solutions to this: diversification, dynamic spending, aka rules that tighten spending after bad market years. So that 4% that you're sticking to that, or you're finding an even more conservative approach and adjusting after bad market years. Another is stress testing against the plan against various market conditions. So some advisors have things called Monte Carlo predictions, all kinds of different opportunities of how they project out different scenarios in the marketplace. These are very helpful. You should be pressuring. I highly encourage you guys, pressure your advisors, put them to work. They work for you, right? They need to earn their keep. And then smarter decumulation. Move from a static 4% to dynamic strategies, integrating market conditions, longevity, and bequest preferences. And permission to spend. Enjoy retirement without jeopardizing security. So if you're planning appropriately, you can have both. You can have your cake and eat it too. And the final list, some of the best things that we found. Demand, I just said this, but let's beat them up even more. Demand more from your advisors. High net worth retirees that find the most success spend more time pushing their advisors to provide the following: technology and innovation. Expect your advisors to leverage modern tools, AI, analytics, robust planning software, et cetera, and to underwrite private markets and tax scenarios with institutional grade rigor. They should be presenting these to you, giving you something with a bow on it so that you can understand all angles and impacts of your investment. Additionally, access to private markets. Your advisors should be creating access to private markets. They shouldn't have their set menu like we talked about. We had a poll here where it feels like the same strategies from 10 years ago. That's the set menu, guys. That strategy dies. Maybe somebody from the Saint team, can you drop in what the previous analysis we did on the different portfolio strategies? I forgot the exact title of the webinar, but we go in detail on this where we talk about, the different portfolio strategies in depth. It's a full focus on portfolio strategies. And then also plan for longevity and flexibility. For affluent households, longevity is both likely and it's expensive. So assume at least a 30-year horizon for retirement. Build flexibility into both spending and allocation. This includes willingness to adjust discretionary spending if conditions deteriorate. You got to be able to spend less if you want to go for the long term. And then last but not least, control your retirement timing. One of the biggest advantages that we saw consistently with high net worths is that they have the ability to control when and how they retire. Many affluent professionals choose to work into their late 60s, for instance, for meaning or for structure or for continued income. But your effective planning should ensure that you don't have to work that long if that's not part of your game plan. And then one thing that we saw consistently with high net worth individuals was phased retirement. So things like board roles, things like consulting, part-time work, these are part of a broader strategy for high net worth individuals consistently, but they also stress test the plan, assuming full retirement. So that extra income or those extra benefits are more icing on the cake than anything. So the goal of all of this, when we look at, a retirement masterclass, when we deep dive on different strategies, when we look at 30-year portfolio outcomes, the goal is building resilience in your portfolio. The real goal, we kind of, use these terms regularly. It's an all seasons portfolio for yourself that will pull you into the future and be able to navigate different strategies. Fixed income and growth are the core of what we consistently see as success. And if you think about it, that was the previous 60-40 portfolio. 60-40, right? We have growth from the stocks on the 60. We have fixed income from the bonds in the 40. The problem is most of that has broken down in many different ways. So many people are using the same concept, fixed income and growth, but applying it to more alternative investment strategies. We're seeing tactical shifts in those way from high net worth investors that are rebalancing their portfolios. And we've seen a lot of scenarios today. We've also seen that bonds have been underperforming and throwing portfolios off for a very long period of time on the fixed income component. So what we've seen consistent and what we get asked consistently is where Saint fits in. We have a Saint income fund. Where does it fit into an investor's portfolio in today's world? We target the fixed income side of that portfolio, that 40% allocation. And that is backed by, on our side, what we wanted to find was the perfect asset class for a 10 to 20 year fixed income time horizon. What we found, bar none, was single family mortgages had the biggest opportunity for a decade plus consistent income stream. What we also found, one of the reasons that we liked single family mortgages above many other asset classes in real estate specifically, is that they fare very well in different rate environments. So let's say that rates go up, which is not what we're looking at today, but let's use the case study. If rates go up, then the mortgages that we purchase that are cash flowing, they're more stable. There are less refinances. The portfolio is more stabilized. The cash flow is more long-term projections. There's less turnover overall. But let's go through today's scenario. With mortgages, if rates go down, it stimulates buying, which means single family homes, that asset class with a 6 million home shortfall, that stimulates buying with prices going up even higher. That increases equity. So the collateral for these mortgages actually goes up. On our side, we do see higher refinance rates. That's great for us because we target discounts of roughly 25 to 27% when we buy mortgages because they're non-performing. So on that side, that's great for us. Paying or buying something at a discount and then getting paid full price on the back end, we'll take that deal every single day of the week. So it actually boosts returns on the back end if rates go down and refinances increase. So if you want to learn more about what we're doing at Saint, how we fit that fixed income piece of your portfolio, how we back that up with over 600 single family mortgages in over 29 states with returns up to 14%, you can call Tom now. His number is, Tom, can you drop your info on the screen there? Or you can call the number on your screen now. And last but not least, we are going to jump into Q&A. Last but not least, these webinar deep dives are something that we love. We love diving in. We love putting together huge amounts of data that change perspectives on the marketplace. We compile these on our YouTube channel, so you can follow the QR code or just check us out on YouTube. And we have a full suite of amazing deep dive webinars that you can check out. You can learn about the various topics. We have everything from the mortgage investing masterclass all the way up to the stock market analysis, all the way up to the playbook for 2026 of the #1 trends in the investment world we're seeing.